All right. Good morning, everyone. Welcome to the final New York City Retirement Systems Common Investment Meeting of 2021. We're going to start by calling the rolls. Let's start with the Teachers Retirement System. I'm here, but you got to turn your mic on. I can't really hear you, but I am here.
John Adler's
Yeah.
here. Thomas Brown,
I'm here.
Natalie Green Giles,
Here remotely.
David Kazansky,
Present. Oh, jeez.
Russell Buckley,
Here.
Deborah Penny. Here. Susanna Vickers.
Here.
We have a quorum.
Thank you, Patricia. And next for NYSERS, Melanie Winery,
Good morning. Chair, Mayor's Office,
John Adler, present.
Comptroller's Office,
David Jetter for Controller Scott Stringer.
Public Advocate's Office, Borough President Manhattan,
James Katz on behalf of Borough President Gail Brewer.
Borough President Brooklyn,
Good morning, Tanya Cantlow, representing Brooklyn Borough President Eric Adams.
Borough President Bronx,
Good morning, Mirtha Camille Sabio, representing Bronx Borough President Ruben Diaz Jr.
Borough President Queens,
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island, International Brotherhood of Teamsters,
Ruben Torres and Lawrence Bosley for President Gregory Floyd.
Transport Workers Union,
Dave Katzman for TWU Local 100 President Tony Utano.
and District Council 37. We have a quorum.
But for the record, Robin Roach on behalf of Executive Director Henry Garita.
Great.
Thank you, Robin.
Okay. Thank you. Okay, so we just have a couple of items of business before we launch in.
Burrs?
Oh, yeah, Burrs, thank you. Sorry. Burrs, Board of Education Retirement System, Mr. Rich.
Yeah, we're represented by trustees Natalie Green Giles and Russell Buckley. We do not have a quorum and we'll administer this business tomorrow at our regularly scheduled board meeting.
Thank you. Did you catch that, Jeff? Okay, great. Okay, couple of items of business before we jump into our regular agenda. First off, this will be the last board meeting for Tanya Cantlow, representative of Brooklyn Borough President Eric Adams. That may be the last time I say Brooklyn Borough President Eric Adams. And we have a resolution that Melanie Winery is going to read for the NYSERS board.
Thank you, John. Whereas the New York City Employees Retirement System recognizes the exemplary service performed by individuals appointed to serve on its Board of Trustees, and whereas Tanya Cantlow has served the City of New York in the system faithfully representing Eric Adams, the Borough President of Brooklyn, and whereas Ms. Cantlow has consistently combined professionalism, dedication, enthusiasm, and knowledge when exercising her official duties, and exhibited a firm commitment to faithfully fulfilling her duties in her capacity as a trustee, and whereas Ms. Cantlow was a unifying force on the board, able to build consensus among the trustees while at all times showing respect for the differing opinions around the board table. And whereas during official proceedings of the system, Ms. Cantlow has shown leadership and professionalism and promoted positive and effective discourse during such proceedings. And whereas Ms. Cantlow has always demonstrated a deep respect for the members, retirees, and beneficiaries of the system, always acting for the benefit of the participants and beneficiaries of the system. Now, therefore, be it resolved that the Board of Trustees of the New York City Employees Retirement System does hereby express its deep gratitude to Tanya Cantlow for her service to the City of New York and this board, the beneficiaries and the participants of the system, and be it further resolved that a true copy of this resolution be presented to Ms. Cantlow along with the trustees' wishes of success in her new endeavors.
Thank you, Ms. Winery. Is there a motion from a NYSERS trustee to
Yeah.
adopt this resolution?
Yes, it has been a pleasure to serve with Ms. Cantlow, and I will happily move this resolution.
Thank you, Mr. Katzman. Is there a second?
Mirtha Camille Sabio for a second. Congratulations, Ms. Cantlow. It's been an honor to serve alongside you.
Thank you.
Thank you. Motion made and seconded. Any further discussion?
This is Melanie. I'd like to thank Ms. Cantlow for her work with NYSER staff during her time on the Board of Trustees. It's truly been a pleasure. She's been extremely supportive, and on behalf of the entire NYSER's team, I'd like to thank her.
Thank you.
Mr. Bosley? You're not on the mic.
Oh, this one. Yes, I'd like to thank Ms. Cantlow. It was an honor and a pleasure working with her, and I appreciate her persistence, her concern for our members, and the hard work that she's put in to make the board a successful board as far as I'm concerned anyway.
Thank you, Mr. Bosley. Any other comments? I'll just echo the comments of my fellow trustees. Tanya, it's been an absolute pleasure working with you. And you've been an excellent NYSERS trustee, and I look forward to great things to come from you in the next administration. Okay, with that, motion's made and seconded. All in favor of the motion, recognizing Tanya Cantlow for her service to the NYSERS board, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Thank you, Ms.
R1.
Cantlow.
Thank you so much.
Thank you. Okay, with that, I'm going to turn the floor over to Alex Donier for some introductory comments or perhaps valedictory comments.
Thank you, Mr. Adler. And I'll remove my mask. Well, good morning, trustees, those in the room and on Zoom. I just wanted to spend a minute just thanking all of you. As you know, today is my last common investment meeting. And it's, tough to leave a place that you have gotten to frankly love over the last 10 years. It's been an incredible personal journey for me. I will honestly look back at my time here fondly and really will remember most the team at BAM that I am incredibly proud of, but all of you, and being able to work with all of you, being able to advise all of you, and the beneficiaries of your pension plans. So I just wanted to share that it has truly been an honor and a privilege for me to serve the beneficiaries of the New York City pension funds over this time. And I am proud of the strong returns and so many things that we have accomplished together during the last 10 years for hardworking New Yorkers. And I am confident that Comptroller-elect Lander, Mike Haddad, my partner of 6 years almost, and the entire BAM team will continue to strengthen the pension funds and ensure the retirement security of the pension funds beneficiaries. And just lastly, wanted to thank Comptroller Stringer for giving me the opportunity to serve as CIO. It honestly has been a privilege of a lifetime. And also want to thank Comptroller Liu for inviting me back in 2012 to join the Office of the Comptroller in BAM. I look forward to staying in touch, listening in on the activities of the pension plans and reading about all the great things you will continue to do together going forward. I wish you the best of luck, continued success, and continue to do the great work that you do for so many. Thank you.
Thank you, Alex. I think I speak on behalf of all the trustees in thanking you for your service to the boards, to the Bureau of Asset Management, and to the City of New York. For 10 years of service, CIO as Deputy CIO for private markets and as Director of Private Equity, and before that, the Emerging Markets Program. Really a tremendous I don't know, a course of success. And I know the funds are in a better place today than when you started. So thank you very much for your hard work on our behalf.
Thank you, John. Thank you, everyone.
Okay, so with that, we're going to move into our regular agenda. And I'm going to turn it over, I think, for the quarterly fund performance overview. And I believe Mike Haddad is going to kick that off.
Good morning, all. If you'll indulge me in just a quick personal moment as well. Alex, job well done. You have left the systems in a better place. The portfolio's in a better place. It has been a pleasure and honor to serve alongside you. And I think all of us are going to miss you. So thank you for that. And as you know, I've been asked to stay on as interim. I'm excited by the opportunity. I'm excited by the challenge. I'm nervous about the challenge. Obviously, markets are we'll get to that later, an expensive place. And I look forward to working with all the trustees going forward on continuing to serve the beneficiaries of your retirement system. So with that, let me go into public markets performance in Q3. And as usual, I'm going to divide my time into 3 different sections. Q3 public markets, challenges going forward, and then your asset allocation at the end of Q3. Next slide, please, Diane. So this slide shows the returns for various different time periods for public markets. I would draw your attention to the 3rd column on this page, which shows the returns for the quarter. And as you can see, most of the returns were wrapped around 0 plus or minus a little bit, with the exception of emerging markets equities, well, I'll get to in a second. Second takeaway from this slide, which speaks to the challenges we have going forward. If you'll look at the 5-year returns for all of these public markets, and just draw your attention to a few different things, is the very, very strong returns in U.S. equities in a few different ways. The outright returns, the returns relative to international equities, and importantly, the returns as against the last column, which is the sum of the 5 different general consultants, their expected returns, which as a reminder, we come from a late 19 as we're doing the asset allocation. So U.S. equities have had a phenomenal run, which is great for us, but a challenge going forward if we expect these returns to moderate back to the mean or something less than that. Next slide, please. So just a couple comments on the drivers of these returns. The positives include the extraordinarily accommodative monetary policy. As a reminder, we have the funds, the policy rate at or near 0, and 120 billion of quantitative easing still going on. And we'll talk again about that a little bit later in this session. Ongoing fiscal support, the anticipation of the infrastructure and the Build Back Better bills were supportive of markets, and importantly, strong U.S. earnings growth. It was just sensational earnings growth in Q3. So with all these positives, why are markets flat on the quarter? We had some negatives as well. GDP growth slowed in the 3rd quarter. The 3rd quarter was also marked by the Delta wave, and we had increases in all the relative metrics in COVID. 3rd quarter was also when inflation started to accelerate, not just here, but globally. And then the negatives, China. So a couple things to mention about China, and this is evident in the negative returns in emerging markets in 3rd quarter. Both the stories of the property developers, Evergrande was in the press quite a bit, as well as some of the policy changes by the Chinese government, and really a crackdown on a few internet industries, social media, as well as education, resulting in down markets in the Chinese equity markets. And then also importantly, the rate cycle globally has changed, and it started with the emerging market central banks. So there's been a handful of rate hikes already, including the big countries of Russia, Brazil, and Mexico. So that kind of concludes Q3, which feels ancient. So let me pause here before I go into concerns going forward.
Any questions either on the screen or in the room for Mike Haddad? I would say if you have them on the screen, I'm not going to see you, just blurt it out. Okay, but no blurting.
Next slide, please.
Go ahead.
So when we think about risks to future returns, I mentioned valuations, and I'm going to go a little bit deeper into that. So on this slide, on the left-hand side, what this shows is the combination of the forward earnings in S&P, as well as the current yield on the Barclays Ag portfolio, which kind of mimics our core bond portfolio. And this graph goes back, I don't know, 40 years or something. And what you can see is we're at the lowest point that we've ever been. Why does that matter? If we go to the right-hand side of this slide, what this shows is a regression of that yield on subsequent returns. This first regression shows is a one-year look back, and implied returns for a 60-40 index portfolio would be 3.9%. Next slide, please. Oh, I lost my other one. There's a 5-year regression too. I'm not sure what happened to that slide, but that shows what that would show is implied returns of around 0 for a 60-40 index portfolio. Now, our portfolios are not that. We obviously have private markets, and we also have active equities in all 3 equity sleeves. But we look a lot like an index portfolio when you look back over time. So let's go into equity valuations. What this slide shows is the forward PE for the S&P 500, again, going back a few decades. And other than the NASDAQ bubble, we're at or near those highs. Slightly comforting is the decline you see at the right-hand side of that. And that's the result of the very strong earnings that I mentioned before. And earnings growth has actually outpaced the equity market returns. Thus, the P's have come down a little bit. In the box on this graph, it shows 6 different valuation measures for the equity market. I'm not going to go through them all in detail. The first 5 all have some measurement of price to some other variable. And what this shows you is, again, going back over history, all those valuation measures would argue that U.S. equities are expensive. The last line in that table shows equities yield versus corporate bond yield, and what any valuation measure of equities against yields shows equity markets as actually being inexpensive. So if we take comfort in yields and we think they're going to stay there, the equity market's cheap. Next slide, please. Oh, there's my 5-year regression. Sorry. So this is again the using that I mentioned this. We'll skip this. Next slide, please. Diane, next slide, please. Another measurement of how expensive U.S. assets are. This compares assets versus GDP. This includes home prices, so it's not just financial assets. And you can see where we are relative to history. I think it speaks for itself. Next slide, please. So if equities are cheap relative to yields, what do we think about yields? So with this slide, again, going back multiple decades, that dark blue line shows the nominal yield on 10 years. At the end of December, that was 143. And again, you can see going back over time, it really hasn't been lower than that, other than the dark days of COVID in March of 20. The darker line is real yields. And again, at or near the lowest point in real yields, with the exception of the late 70s, when inflation, as a reminder, was low double digits. And anytime we're comparing something to the 70s, it's not something that is a favorable comparison. Next slide, please. Any comfort in credit spreads? Not really. The top line is high yield spreads. The bottom line is IG spreads, and spreads at or near all-time tights as well. So not a lot of additional yield coming from the credit markets. Next slide, please. And then lastly, there's the Federal Reserve, and this ties in directly to what our concerns should be about yields. And as you all know, the Fed is concluding its 2-day meeting today. We'll hear results from the Fed around 2 o'clock today. And some simple facts. The economy is at or near full employment. Inflation is well above its target. It's been there for quarters. It's exceeded its target by a lot. The Fed and Powell has acknowledged this. They announced the tapering last month, and expectations for today is an acceleration of that tapering, which then allows for rate increases once the tapering is done. And in the rates markets, what they care about obviously is when tightening starts, the pace of tightening, and the ultimate target of where tightening is going to go. On top of this is the complications and uncertainties over the Fed's balance sheet, which is the opposite of quantitative easing. Will the Fed engage in quantitative tightening? And these are all dynamics that we're going to have to deal with going forward. And then the obvious caveat, the policy path of the Fed is dependent upon all COVID developments, including what we're dealing with today, the Omicron developments. So before I go into asset allocation, let me just pause here for any questions or comments on risks to the future portfolio returns.
Any questions in the room or on the screen? No? Is that no? I thought I might see a hand. Any questions? No. Okay.
Larry has a question.
Oh, Larry has a question. Sorry.
Yeah, I was hearing this morning that there was a possibility the Fed might not.
Hear you, Larry.
Oh, sorry. I was hearing this morning that there was a slight possibility that the Fed, after the meeting, might not raise interest rates because they're waiting for, they're trying to figure out if full employment, some 600,000 people that stepped out of the market might come back, or if they're permanently out of the market. So they may wait a little while to see if those people start to come back. Do you think that's a possibility, or is that really not?
Let me address the first part of the question. They're not going to raise rates today. They're still easing policy. Quantitative easing is they're easing, and they have to finish that program before they can actually raise rates. And the acceleration of the tapering would then put them in the position in March to begin to raise rates if they need to. As to the employment question, you bring up a great point. The question is the economy at full employment or not? Obviously, we don't know. The labor force has shrunk, and a big part of it has been retirements. If you look at the trend level of retirements, there's been an excess of about 2 million workers who have retired relative to trend. And the question is, will they come back? My 2 cents would be the in the demographic of, I think it's 55 to 64, unlikely, or certainly at a lower pace, just given the age. The interesting one is some of the younger demographics that have had a decrease in the labor force. And one would think they would come back to work once COVID concerns have gone down, the unemployment benefits have ended, so that kind of pushes people back into the labor force. But one of the less publicized statistics has been the increase in self-employment. So there has been a massive amount of new companies started by young people in all sorts of different industries. And they fall out of some of the labor statistics, but they're starting new companies. So I think that they'll actually hire more people. So I do think the labor force expansion will happen. And another thing with the Fed, they have been very focused on an inclusive recovery in employment. Black and Hispanic employment has lagged white and Asian employment for a long period of time, and they want the recovery to be more inclusive, which again may make them a little slower to slow the economy relative to what they might have done otherwise.
Do you think Build Back Better will have some effect positively or negatively on our returns in the markets? Because there's this discussion about how it's going to flood, continue inflation because it's flooded, all this money's out in the market. How do you feel about that?
I think that one's out of my pay grade. You have to talk to Chair Powell about that one. The positives are it's going to be supportive of growth, without a doubt. It's pro-growth. There's some great policy, there's some great programs included in that. The negative, if there is an increase in the debt and deficit of the country, and will that lead to higher interest rates and slow growth? We don't know. Chair Powell doesn't know. That's a Senator or President Manchin, as he's called now. He doesn't know either.
Any other questions for Mike at this stage? Online, on Zoom too, you can ask. Okay, I think you're good.
Next slide, please. So asset allocation for your portfolios at the end of Q3. This slide shows the summary of rebalancing activities in Q3. The top part of the slide shows it by system. The bottom part shows by aggregate. And what the aggregate shows is about $1 billion of outflows out of the equity markets. And what you'll see in later slides is we've been running the portfolio a little bit overweight equities, all three sleeves, US, EFI, and EM. And we've been underweight fixed income during that time. And roughly 2.5% to 3% per quarter. And as we exceeded that, we reduced the equity market overweights. And so a small bit of that in Q3. The other lines you'll notice in the aggregate is some inflows and outflows into the IG corporate asset class. And that all had to do with the implementation of the new credit managers that the board selected several quarters ago. So that was just into new managers and out of existing managers. Next slide, please. So remember, these bubble charts are broken down into growth assets, inflation assets, and deflation assets. This is the growth assets in your portfolio. And as I mentioned, the first three columns here are US equities, EFI, and emerging market equities. And all the portfolios were slightly overweight during the quarter. And this had been consistent with Q2 as well. The rest of the assets at or near policy. High yield, as a reminder, it shows slight underweights, but that has more to do with some of the high yield serves as a placeholder for OFI. So that's why that exists. Next slide, please. In your inflation protection assets, we were at or near policy throughout the quarter. Next slide, please. And for your deflation protection securities, asset classes, this is where we had slight underweights. So you can see in treasury, slight underweights, in mortgages, slight underweights, in credit, slight underweights, and then slight overweights to cash. As a reminder, our strategic allocation to cash is 0. We have to maintain some cash in your portfolios due to the inflows and outflows that happen. But that's just, it is what it is. Next slide, please. And as we all know, in core fixed income, it's not just where we are versus targets, it's where we are versus your durations. And I would draw your attention to the duration targets on the second row in this line. And then the fourth row in this line is the actual durations. And as you can see, we're at or near your duration targets at the end of Q3. Last pause for any questions or comments on asset allocation.
Anybody online? Okay. Thanks, Mike.
Thank you, Mike. Good morning, trustees, once again. We'll now turn it to the performance review for the third quarter of 2021. Next slide, please. Thank you. On this first page, we have plan assets by systems and in the aggregate as of September 30th, 2021. And in aggregate, the systems assets stood at approximately $267 billion. Next slide. Now, for the third quarter of the calendar year, returns by system range from 15 basis points for teachers to 82 basis points for police. Now, the systems posted generally flat to slightly positive returns in Q3 as global equity markets were negative. Now, in the quarter, the systems did manage to outperform an index portfolio. And this is primarily driven by the system's exposure to private markets, which generated very strong returns in the quarter. And those returns are reported on a lag for private markets, as you know. Now, I will mention that teachers' relative underperformance was due to the portfolio's exposure to emerging markets, which significantly underperformed in the quarter. And for police and fire, their relative outperformance was due to its allocation to hedge funds, which actually outperformed in the quarter, but also generated positive returns. So that helped to boost those returns on a relative basis for police and fire. Now, although the systems lagged the 7% assumed rate of return in the quarter, they all significantly exceeded the assumed rate of return in the trailing fiscal year, 3-year, and 5-year periods. In addition, all systems outperformed a 65-35 index portfolio over the trailing 5 years. I would note that BERS and police outperformed other large pension plans as measured by TUX in the quarter. And once again, remind you that TUX figures are reported gross of fees. Next slide, please. So here we have total portfolio performance for each system for the quarter versus each system's custom benchmark. Now, all systems underperformed their custom benchmark in the quarter, as you can see from the bar chart on the far right-hand side of this page. And the horizontal line represents the 7% target rate of return for the quarter, which, as I mentioned, all systems lagged. Next slide, please. Now, when you break down the components that contribute to the underperformance for all systems, you'll notice that it's a bit of a mixed picture in the quarter, but slightly more due to asset allocation, which is those middle bar charts. The systems, as Mike mentioned, were slightly overweight to public equities across all 3 sleeves. And emerging markets, once again, which was down 8% in the quarter, underperformed and hurt all systems' returns. Next slide. Here we show U.S. equities performance versus the benchmark. I will mention that note that while teachers performed in line with this benchmark in U.S. equities, the other 4 systems underperformed their respective benchmarks in the quarter. Now, the reversal of the rotation to value over growth actually continued in the third quarter, with the Russell 1000 Value Index trailing the Russell 1000 Growth Index by 1.94%. I will note that for NYSERS, police, and fire, underperformance was driven by value-oriented managers, such as research affiliates and scientific beta, while positive relative performance from several small-cap active managers helped to mitigate some of this underperformance. For BERS, the underperformance was driven by his mid-cap active manager. Next slide, please. Here we present your EFI portfolio. For the quarter, all systems underperformed their respective benchmarks. Now, this underperformance was primarily driven by Bailey Gifford and Spruce Grove, which significantly underperformed in the quarter. I will mention that out of benchmark exposure to China magnified this underperformance for police, fire, and BERS that are allowed to make out of benchmark bets in the EFI portfolio. Next slide, emerging markets. So here we show emerging markets for the quarter. All systems outperformed their respective benchmarks. However, I will reiterate, overall returns in the quarter were meaningfully negative in emerging markets, as China, which accounts for 30% of the index, fell 20% in Q3 due to regulatory concerns and the concerns, as Mike mentioned, from the Evergrande. Next slide, please. Now moving to core fixed income. Overall returns in the quarter were slightly outperformed the benchmark for all systems, although I will note that absolute returns were near zero in Q3 for all systems. The fixed income markets were flat in the quarter, as measured by the Barclays Agg that was down 1 basis point in Q3. Let's turn to high yield on the next slide. So in high yield, there was mixed performance across the systems with the benchmark versus the benchmark, with fire and BERS slightly ahead and teachers, NYSERS, and police slightly trailing the benchmark. Now, in the reversal of prior quarters, higher rated BBs outperformed lower rated CCCs in Q3. While similar to prior quarters, energy remained the top performing sector in high yield, followed by restaurants and railroads. Now, the index returned 89 basis points in Q3, and the total program lagged the index by 6 basis points. Next slide, please. Here we show you the hedge fund portfolio for police and fire. The hedge fund portfolio significantly outperformed the benchmark in Q3 and also outperformed in the calendar year and trailing 3-year periods, even as equity markets continued. So hedge funds continue to do well in 2021. Now let's turn to private markets. 2 slides forward, please. So we begin with the OFI portfolio and its performance in the third quarter. Now, while OFI is trailing the benchmark since inception, which is a public market equivalent plus a 300 basis point illiquidity premium, in the aggregate, the OFI portfolio since inception has returned 8.27% compared to 6.32% for the PME. In Q3, the OFI portfolio had a net return of 2.76%, outperforming the custom blended PME benchmark, which returned 85 basis points during the quarter. And for the fiscal year, the portfolio returned a strong 12.5% versus 4.6% for the PME. Now, in terms of asset classes in OFI, securitized products outperformed, as well as middle market direct lending strategies. Let's turn to private equity on the next slide. So here we have PE performance for the second quarter of 2021, as performance is reported on a lag. Second quarter since inception returns for all systems range from 11.5% for NYSERS to 15.3% for BRRRRs. Now, as shown on this chart, teachers, police, fire, and BRRRRs outperformed the PME since inception, which is a Russell 3000, while NYSERS slightly lagged, and all systems continue to lag the PME benchmark, which is the Russell 3000 plus 300 basis points. Now, the overall portfolio improved by 59 basis points in absolute returns in the second quarter versus Q1, while the PME increased by 41 basis points, which results in the PME spread for the portfolio increasing 18 basis points from Q1 to Q2. Now, the PE portfolio valuation continues to strongly recover and perform, and is actually up another 12.1% in Q2 versus Q1. Next slide, please. So here we have the core real estate portfolio. Looking at Q2, since inception performance, core real estate investments are underperforming the PME benchmark for all systems except for BRRRRs. Core real estate valuations actually rebounded and continue to rebound, I should say, in Q2 for the third consecutive quarter as fund managers continue to gain and regain confidence. I would note that the core plus portfolio's performance has now fully recovered to pre-COVID levels. Next slide. And here is non-core real estate. Looking at second quarter since inception performance, teachers, NYSERS, and BRRRRs non-core investments are outperforming the PME benchmark, while police is flat and fire trails. Now, in addition, I would note that the non-core portfolio was marked up 22 basis points in the quarter versus Q1, and this is the fourth consecutive quarterly valuation markup since the beginning of the COVID-driven valuation markdowns. And last but not least, infrastructure. So here we have performance for infrastructure for Q2. Infrastructure continues to perform very strongly with since inception second quarter of 2021 returns of 12.2% across all systems. And all systems have outperformed both their PME benchmark and their IPS benchmark of CPI plus 400. I would mention that co-investments are also performing very strongly for all systems, delivering a net 18.6% net IRR in the portfolio. Again, renewables and transportation are your largest exposures by sector at 21% each as of the second quarter. And North America and Europe are your two largest geographic exposures at 47% and 35% respectively. That concludes my prepared remarks on third quarter performance, and we'll take any questions.
Questions for Alex on the performance report from the room or online? I just have one question, Alex. So you talked about the out of benchmark bets in China, but you're saying that, and that dragged down the EFI performance?
The EFI portfolio.
Because
yes.
those developed market managers can, how much are they allowed to put into emerging markets? Do you know? Is it varied by manager?
Exactly. I think John is here to answer that. About 15% for certain systems.
Uh-huh.
I'm sorry?
But
Right.
teachers is zero, but yeah, John, they can't hear you online.
Yeah, teachers is zero, which is why I mentioned that the out of benchmark bets in EFI magnify the underperformance for police, fire, and BRRRRs.
Oh, but not for teachers? Because teacher, I
No,
thought you
because-
said, so it's the teachers emerging markets portfolio.
Yeah, teachers
exposure to
emerging
China
markets portfolio
That,
it was down 8% in the quarter. And they also have a higher weight to emerging markets relative to the other systems.
uh-huh.
So that's how you look at the relative performance. You see teachers coming in at 15 basis points versus the other systems, and at the high end, police and fire at 85, 71 basis points respectively. And theirs are also aided by their lower exposure to equities, John, which was lower in the quarter, and their exposure to hedge funds, which actually had positive returns.
Okay, understood. Thank you. Any other questions for Alex or for John Mercerberg while he's here? Okay, thank you. Okay, so that, oh no, we have Dan Haas with the risk update. And I saw Dan lurking online.
I'm here. Can everyone hear me okay?
Yeah.
Yes.
Great. Yeah, well, hello from my living room. My apologies for not being able to be there in person today. I was quite looking forward to it. And unfortunately, my wife and youngest daughter kind of reported home sick yesterday. So discretion being the better part of valor in this case, here I am. Hopefully we can catch you next time though. I guess before I jump in, Alex, I just wanted to also express my appreciation. I suppose I qualify as part of the old guard at the comptroller's office with 8 years under my belt, and it's been a real pleasure working with you. And I sincerely hope that we cross paths again in the future. But best of luck.
Thank you,
and thank you. Yeah. Anyway, John, thanks for the introduction and good morning, everyone. Today, we'll spend a few minutes reviewing the highlights from your quarterly risk reports, and then we'll move on to examine some MSCI stress scenario, framing the market's reaction function to Fed tapering and rate hikes. And why don't we jump right in? Thanks. Okay, again, this is an example of the risk summary that appears on your quarterly reports. If we look at the top left panel, you'll notice that the total plan risk for the quarter ended September 30th was 12.11%. That's down slightly from 12.77% in June. The benchmark risk is 10.93% in September, declining from 11.74% in June. Benchmark risk here declined a little bit more than portfolio risk. And we see small corresponding pops in active risk and beta. The active risk this quarter was 2%, up from 1.85% in June. And beta is at 1.1, up from 1.08 back a quarter ago. The table and chart off to the right, up top there, show you the differences between your portfolio allocation by assets and your allocation to risk. As before, you note that we've allocated a little more than 2/3 of our assets to equities. However, we're deriving most of our risk, close to 91% of our risk from those investments in the equities. The chart, of course, on the top right there, just shows that same information graphically. If we look at the bottom there, the portfolio risk, we're plotting the 1-year trailing portfolio risk in the blue line. The benchmark risk there is the red line. And the portfolio beta are the gray bars. And that's monthly observations for the year ended in September. You'll notice here that the projected portfolio and benchmark risk continue their downward trends. Over this period, we noticed that reductions in risk due to diversification benefits or lower correlations and reduced volatility have been offset slightly by increases in portfolio exposures to factor risks. Same theme, again, that we've been showing over the last couple of quarters, and we'll detail those a little bit on the next slide. So here we're decomposing the change in risk from June to September into 3 broad categories, as we have in the past. There's the change in volatility, the change in correlations, and the change in portfolio exposures. The change in volatility and the change in correlations categories are market-driven phenomena, meaning that these risks decline in step with market risks and were not the result of specific position weights or tilts in the portfolio. You see those corresponding to the blue arrows in the table there. Bringing your attention to the second line on the table, we see that the reduction in market volatility accounted for a 79 basis point reduction in risk. 64 basis points of this was driven by country factors, which were led by the US and Eurozone markets. If we move on to the third line, we see that the risk attributed to changing correlations was also down slightly for the quarter. And this continues the trends we observed over the last few quarters where correlations are relaxing a little bit and it offers us greater overall diversification. Finally, the portion of the risk that was detached from market trends is grouped in the last line there, labeled the change in portfolio exposures. Here, risk increased slightly by 21 basis points, and that was led by a rotation into the U.S. style and market factors. Next slide, please. Here we have our factor risk decomposition. The table at the top left, we're examining our exposures to MSCI's macro factors. The risk here is decomposed among two principal categories. This is a local market risk and the currency risk. And you can see the components of each of those broken out among the rows at the table on the top left there. Looking at the columns, you'll find that the portfolio and active risks broken out in absolute and percentage terms along with their correlations. It's a good reference, of course, to show you which factors are contributing the most to the portfolio risk. Table at the top right shows you which of the macro factors contributes the most to active risk or risk relative to the system's policy benchmark. And then looking at the graph at the bottom, again, we're plotting our factor exposure here among our broad equity and fixed income asset allocations. You see the risk is dominated by the equity factor, as was kind of evidenced in the previous slides, and that's represented by the light blue shading. And you'll notice that equity exposure appears in both our equity and fixed income portfolios. Similarly, we see fixed income factor exposure also in our equity portfolios. It's an important distinction of the factor risk versus the risk associated with specific strategies. The factor risk is a common attribute that reveals itself in our various investment strategies. Move to the next slide, please.
Can you slow down a little bit, please?
Certainly, I'm sorry. I tend to drone on quickly. I guess as we move away from the content shown in your quarterly risk packages, we'll now examine some of the MSCI research that attempts to frame the market's reaction function to how the Fed implements QE tapering and rate hikes. As you know, we're getting notes on this from the Fed this afternoon, and it's an active, nearly constant discussion in BAM during our rebalancing committee meetings. It's also a theme front and center among many asset managers. In fact, just yesterday, one of my colleagues in BAM shared the results of a Bloomberg News poll of investment managers that asked them to define their largest downside market risk. One of the 106 managers responding to the survey between December 3rd and last Monday, a little more than a third of them cited tapering and rate policy mistakes as their largest downside risk. And about another third of them cited a related issue, runaway inflation, as their top risk. And then the last third kind of cited all other reasons, including like COVID-19 resurgence or geopolitical disruptions as their largest downside risk. In short, 2/3 of those managers are most concerned about the path and timing of rate changes stemming from the Fed. That leads us to the slide we have in front of us. This shows you a summary of 3 stress scenarios developed by MSCI's research to frame market responses to Fed tapering and potential rate increases. There's a sort of a Goldilocks scenario here that's where the Fed is either too early nor too late in implementing expected macro policy, and then the amount of that intervention is neither too large nor too small. And then there are the other 2 scenarios where the markets rather view Fed activity as either too interventionist, that's a too much too early scenario, which serves to stymie economic growth, or the Fed's response is seen as either not timely or not sizable enough. That's the too little too late scenario you see there, and that ends up where the markets end up kind of chasing inflationary pressures. The table that you see there really just kind of lists the specific shocks that MSCI prescribed for each scenario. We ran these shocks. I won't bore you with the details of them, but you can certainly examine them. If you have any questions, I'm happy to take them. But we ran these shocks through the sample portfolio as of November 30th, just to kind of give you a sense of what that response function is within our portfolios. We can move to the next slide, please. Here, we're showing the predicted returns for each of the scenarios for both the overall portfolio and then for selected strategies within our portfolio. Each scenario is represented by a different colored bar, and the resulting predicted change in value is, of course, plotted along the horizontal axis you see there. At the total portfolio level, you can see that our results range from a 7.5% increase under that ideal timing scenario to about a 15% or 14.8% decline in portfolio value under the too little, too late scenario where we have rampant inflation, or we're chasing rampant inflation. To the extent that you lend credence to MSCI's assumptions, the main takeaway here is that there's a fairly narrow path for continuing growth. There isn't a lot of room for upside in the portfolios, and to the extent that the Fed is out of step with market expectations on the timing and size of tapering and rate actions, there's quite a lot of room for downside. In my mind, it really sort of underlines the need for the Fed to clearly telegraph its intentions to the market and to carefully consider any changes to their strategy. That's all I have for you today. Happy to address any questions that you may have now or offline later on if you like. Thanks.
Thanks, Dan. Any questions for Dan Haas on the risk report? Okay, I don't think so. Thank you, Dan.
Okay, thank you. Have a great day.
Okay, I believe that concludes the public agenda. So with that, let's entertain some motions to exit public session and go into executive session. Can I get a motion from a NYSERS trustee to do so?
So moved.
Thank you, Mr. Katzman. Is there a second?
Second.
Thank you, Mr. Jeter. Any discussion? All in favor of the motion at NYSERS to exit public session and enter executive session, please say aye.
Aye.
Okay, all opposed, please say nay. Any abstentions? Motion carries. And at teachers, is there a motion to exit public session and enter executive session?
Tom Brown, so moved.
Thank you, Mr. Brown. Is there a second?
Second, Susanna Vickers.
Thank you, Ms. Vickers. Any discussion at teachers? All in favor of the motion at teachers to exit public and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. So let's turn the cameras off and we will enter executive session. Reporting on, please, McKay. Okay, we are back in public session. Ms. Winery, would you please report out of the executive session?
The board agreed to commit funds to a private equity investment, a reallocation of a previously approved private equity commitment, and an opportunistic fixed income investment. The board also agreed to approve annual plans for public equity, public fixed income, and alternative credit in all of their components. Details will be released at a later date.
Great, thank you so much. That concludes our agenda for today. Is there a motion to adjourn?
Motion.
Thank you, Ms. Roach. Is there a second?
Second, Martha Camille Sabio.
Thank you, Ms.
Thank
Camille
you.
Sabio. Any discussion? All in favor of the motion to adjourn, please say aye.
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 All opposed, please say nay. Any abstentions? Motion carries. Meeting is adjourned. See ya.
Win-win.
Thanks, everyone.